Have we just reached a tipping point in markets? And more importantly, why is volatility still elevated and should it make us as traders and investors concerned? Today, we're going to talk about earnings, the economy, and sentiment as some of the biggest stocks in the world start to enter correction territory. So should we hedge our portfolios, take risk off the table, or should we look at these as fantastic opportunities for all of us to take advantage of? Today, we're going to discuss that and look to the future. Taiwan Semiconductor, a bellwether for all semiconductor stocks, is supposed to report earnings next week, but they gave us an early look into their earnings. We're going to go over it, and things are not quite what they seem. So in times like this, when there's so much noise, fear, uncertainty, and doubt, it's always good to get back to the fundamentals. So today, we're going to break down market breadth, gamma, and some of the key charts to get a well-rounded idea of where we are and where we're going. We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers. Now, if you were a trader or investor in 2023, this is what the heat map looked like from January until July. It was literally just semiconductors lit up like a Christmas tree. Green Microsoft, strong Apple, strong Google, strong Meta, strong Amazon, green Tesla, and then the leaders in each sector, stuff like GE, Costco, Visa, the best performers, and then everything else red. Even though the majority of stocks were down, we still went up because the big names, the big boys put out the big numbers, and oftentimes that's enough to move the market. And we could see that here today. We had Apple, one of the biggest stocks in the world, Microsoft, and Nvidia, right? The three biggest stocks in the world, you put up gains more than 1% in a single day or 4% plus, and you're going to see the nasdaq outperform. You're going to see the S&P 500 market cap outperform the RSP. Diving into actual sectors, we can see this performance right here. Have a look at the SPY, up 0.75% for the day, right? And then we have a look at which stocks beat the SPY. Discretionary, so Amazon, Tesla. Then XLC, okay, Meta, Google. XLK, Microsoft. GDX, we know why they're running, thanks to gold. And then semiconductors, which is Nvidia and semis, right? So pretty much the Magnificent Seven, okay, lifted the entire SPY, and then everything below underperformed the SPY. We had XLRE barely put up a gain after being an actual dumpster fire yesterday. Regional banks, and let's just be honest, regional banks, real estate, this could be a dead cat bounce from yesterday's 4% down move. And then we had XLB, XLE, XLU, XLP, XLV, so like defensives, underperform the SPY. And yeah, the reason why we went higher today, it was a mega cap trade, it was a technology trade, and the leaders in each sector. And normally when you have, the top 2, top 3 stocks in a sector of 300 really outperform, you generally have an up day if you're in market cap weighted indexes, stuff like the NASDAQ 100, stuff like the S&P 500. And this is not necessarily a bad thing. Essentially, what this is telling us is that we're sort of back to risk on. And the reason why we're back to risk on had to do with PPI. PPI came in a lot cooler than expected. We were expecting 0.3% month over month. We came in at 0.2, and that was a 2.1% gain year over year. We were expecting 2.2%. The market really liked that. At the same time, what we also saw was strong dealer demand, a strong non-dealer demand, at the 30-year auction. But the auction did tail, so dealer demand wasn't strong, non-dealer demand wasn't strong. So the market does like that because dealers have to take up the bonds at the end of the day. But if non-dealer demand is high, stuff like Japan, China, Europe, if that demand is strong, that's a really positive sign. And then we also had Nvidia and Apple both gained 4%, right? And the second these two names gain, the market's going to really rally because these are big hitters in the S&P 500. And that's why it was risk on today. And that's why you saw risk on assets in favor of risk off assets. And in an environment where it's risk on, and there is that inflationary worry that's still looming on the market. And when it's risk on, you're going to go to the big names. You're not going to screw around with some $1 billion software company that's not profitable, that's relying on equity funding or debt funding. No, you want to go to sustainable businesses that's making 50, 20, $100 billion in free cash flow every single year. And that's why we saw the trade that we did today. Now let's hop on the charts. All right, guys, before we hop on the charts, Let's have a look at the major indexes. So the S&P 500 up 0.74%, the nasdaq 1.65%, and definitely a flight to quality, especially the mega cap names, the best stocks in each sector, because look at the RSP down ever so slightly. Same with mid caps, although slightly in the green. What did perform well though was 600, S&P 600 and IWM small caps, and I think this has to do with interest rate risk. Non-dealer demand at the 30-year was stronger than expected. That is going to help the perception of yields, and that's probably why they outperformed. We saw growth outperformed value, obviously, and then looking at some of our other proxies, we saw Bitcoin down 0.61% for the day. Gold and silver precious metals up 1.73, 1.94%. The dollar was largely flat. Oil is finding major resistance here at this $88 level. That's actually what we said would happen in yesterday's video or the day before that. We said a bit of consolidation before the next move higher to $90 and above. Yields was very, very mixed. The longer end was up, the shorter end was down. Let's look at the S&P 500. So a couple of things. Number one, let's actually have a look at the advanced decline line. So, the advanced decline line is behaving as it should for the most part, but if you really want to get real nuanced with it, we put a low right here and then a lower low here in the S&P 500 at the same time, right? We actually put a low right here and then a slightly marginal higher low in the S&P 500. So that is a bit of a divergence. That is a positive development, but to be honest, I think it's inconsequential. Now, let's dive into the monthly chart. I know the month's not over. What can we tell from this? Absolutely nothing, okay? We're in a massive uptrend and we're having a bit of monthly volatility and we're nowhere near the March lows. That's all the monthly chart is telling us. There's not much we can derive from it at all. Looking at the weekly chart, very similar situation, okay? We're approaching 2 to 4 week lows. That's pretty much it. And we've seen quite a bit of buy side activity come in here at the 51.40 level. Bulls seem to like that level for the most part. On the weekly chart, we said yesterday that really until this level is broken below, then we could really start looking at some serious downside. But we're nowhere near that level, 49.77, the 5,000 level. I think we're going to get good structural support right there. And if it does break to the downside on volume, that's when we can start getting worried. But until then, the weekly chart, the monthly chart look very, very bullish. Now, what about the daily chart? This is where things are starting to break down a little bit, but we are starting to see bulls come in the market right here. But looking at structure, okay, let's actually look at the structure on the ES. I do like the ES a little bit more in terms of the fluidity of the candles. What can we actually see? Okay, we put a high in here, then we put a lower high, another lower high. At the same time, we put in a low, then we put in a lower low, lower low, lower low, and then we're starting to see bulls come in with this 2 equal lows, these wicks right here in the last 2 days. So what's that telling us? Yeah, the trend at the moment is down. However, we are starting to see bullish demand come into the market after the PPI print we got. Okay, heading back to the SPX. Now we can see a couple of very key things. Number one, this candle right here, a green bodied candle well above both the open and close of yesterday's candle, a huge wick closing in the top third of the overall candle. That's very bullish. Sellers did come in at the top, but this is a very bullish candle nonetheless, especially considering the candles we've had. Looking at the 5-minute chart and what we actually did, we gapped up on the open and then traded lower, and then bulls found value at yesterday's lows right here, right here. So the 51.40 level, 51.50 level seems to be a very strong line where bulls come in. And then bulls for a good number of hours took us all the way up. It was just higher highs, higher lows until we found a top right here at the 52.10 level, the gamma flip zone. And then we did see sellers enter the tape. And I would say that sure, some sellers did enter right here, but you see this 5-minute gap that you see right here and this candle, this tells me that it was more 0 DTE hedges rolling off than it was convicted sellers coming in and putting on positions. Secondly, this right here, 51.99, that's where we closed today. So what is so important about that level? It's our gamma flip zone. So above the 5200 level, okay, you want to buy dips, sell rips, and aim for the call gamma resistance, which right now is still 5300, which is kind of crazy when you think about that. That is also a bullish sign. The call gamma zone hasn't flipped lower. So if in positive gamma, we will look to our upside target of 5300. A couple of other glaring things we're seeing in the market right now is this level right here. So remember last week's NFP print where the market sold off on the Thursday and then rebounded on the Friday right there? Okay, yeah, that was the low. We have then since broken that low, but bulls have bought the dip at this 41.50 level very, very quickly and very, very decisively. And we saw that today. They bought the dip and we rallied all the way to the gamma flip zone, which often does act as very strong support and resistance, as you can see right here, 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 and here. So what does that mean for stocks? Right now, if bulls want to continue this rally, it's very, very easy for them. Get above 5,200 in positive gamma, have dealers help you push, break above those highs tomorrow. That's what the bulls need to do. The bears have a lot more work cut out for them. They need to make their way to 41.46, closed at these lows around here for the week. It's a lot harder for the bears to do that, especially after a cool PPI print. And I also just want to say, heading into earnings tomorrow, next week, and from here on out for Q1, us trading lower or trading sideways is not necessarily a bad setup. Imagine if we were at like 5,300, 5,400 right now heading into earnings. There would be so much to be expected of stocks to go ahead and beat, and that's when you actually see a massive amount of trading lower. So it's not necessarily a bad setup, and with the bullish action we're seeing today, we just want to see follow through. Bears had the opportunity to follow through, they couldn't do it. Now bulls have their opportunity to follow through and push higher into earnings. Now guys, looking at the AA sentiment survey, essentially the question that's asked is, what direction do AII members feel the stock market will be in the next 6 months? 43.4% said bullish. Now that is a big number in comparison to the historical average. But you do have to understand that bullish sentiment has actually ticked down in the last 2 to 3 weeks. At the same time, we've actually seen bears expand ever so slightly, and we've also seen major expansion here in the neutral zone. So things are still looking bullish in comparison to the historical averages, but things are becoming ever less so bullish than they were a couple of weeks ago. And that's also being reflected in the price action. Now, yesterday, we had a gap down of more than 1% on the CPI news. That has happened a number of times, and this is the forward returns up to 3 months later, what normally happens. And you could see up to a week later, it tends to be fairly negative. 3 months later can be positive. But look at the hit rate, 60%, 55%. The hit rate isn't that positive. And essentially what this data is telling us is that a gap down on CPI news, which essentially would mean a miss, probably not a good thing for stocks. And normally what happens is the market goes into price discovery mode to the downside. But generally speaking, we do par a lot of those losses 1 month, 3 months later. Now let's actually talk about CPI and inflationary pressures. Now what we actually saw in yesterday's print was that core goods is actually in deflation. Core goods continues to be in deflation here in the March print. What really kept inflation hot was actually core services. You could see that core goods CPI inflation declined negative 0.15% month over month. Core services accelerated 0.52%, and that is why we got the hot print. And a major component of core services is shelter. And until we have a massive deceleration or deflation in the shelter component, I think core services is going to continue to remain at this sticky level here and keep CPI and inflationary pressures elevated. With that being said, is the macro and fundamental picture any worse than what it was a day ago? Not necessarily. We could see here that the Fed GDP now is still sitting at about 2.5% for the first quarter here in 2024. At the same time, the unemployment rate is sitting at 3.8%. And sure, you may look at this and say, hey, it's actually accelerated in the last couple of years, but a 3.8% unemployment rate is actually really low relative to history, and anything under 4% is really good, exceptional actually. And at the same time, S&P 500 earnings is forecast to be at about 5% year-over-year growth for Q1 2024, and excluding energy, we're looking at 8% growth. So the economic picture, the labor market, as well as S&P 500 earnings is all looking really good. And on the macro front and the fundamental front, nothing has really changed. The only thing that's really changed is technical picture in the S&P 500, as well as the inflation picture. So the Fed and policymakers have quite the task on their hands in terms of how they're actually going to navigate the inflation front, particularly shelter. And the problem that they've made for themselves is that they've sort of sandbagged themselves into, we're definitely getting rate cuts this year. So I don't know how the Fed is going to tackle this. It's going to be a very interesting 2 to 3 months, especially leading into that June, July area when the market is or was expecting rate cuts. Now, let's actually talk a bit more about earnings. We got some earnings data of a critical company in the S&P 500. TSM released their revenue. Now they report earnings next week, and they dropped their revenue yesterday. So their revenue for Q1 2024 was plus 16.5% year over year. The street was actually expecting 16.3, so a slight beat. But here's the crazy part. March revenue for the month was plus 34.3% year over year and plus 7.5% month over month. We're seeing some real acceleration right now in the semiconductor space. And that's why if you go look at Nvidia's chart yesterday, not today, yesterday, Nvidia was up like 1.4% when the broader market, the S&P 500, was down about a percentage point on that CPI news. That is actually the reason why Nvidia was up. So, the semiconductor space, it looks like they still got legs, and TSM is a really great parameter for how all semiconductors are going to report. They normally go first. If they report good earnings, and we know Nvidia reports good earnings, and everything else comes as a result. And at the end of the day, this is the stuff you want to look at. Is the economy good? Is the fundamental picture good? Because those are the things that drive stocks in the long term. And that's what we want to do. We want to buy stocks, hold stocks for the long term. And the short-term volatility, we just have to wait it out, because volatility is the price we pay to invest. Since 2008, the S&P 500 has returned 16% per year, every single year. So to get these exceptional returns, we do have to accept volatility. And on average, we get 3% dips every single year. We get about 5% dips called a mild correction, and then 10% correction. And if we do pull back 10% from where we are right now, 100% healthy, it's to be expected. We actually get 10% correction a year. And then once every 2 years, we get a 15% correction or a severe correction. So volatility is the price we pay to invest, guys. Sometimes the best thing that you can do when volatility does come into the market is have your watch list of stocks ready, sit through the volatility, and be ready to buy the dip, because at the end of the day, stocks will go higher. The fundamentals are sound, earnings is growing, margins are expanding, the economy is in good shape, people have jobs, there's plenty of cash on the sidelines. So buy the dip, don't trip. Okay guys, looking at gamma. So guys, we are in negative gamma. We are below the gamma flip. At the same time, we can see an overwhelming amount of negative gamma, which means retail is buying downside protection. That's why we're in negative gamma. At the same time, we can still see that the call gamma resistance is at 5300. And look at the amount of jacks on the charts right here. That's a lot of jacks on both the negative gamma side and the positive gamma side. So these strikes are huge. So this upcoming April OPEX is going to be very big. It's going to be wild swings, especially in negative gamma. So do be prepared for that. In times like this, when we are in negative gamma, guys, and we do get quite a lot of volatility in the market, sometimes it's good just to, draw some cash. Let's say you have $100,000 portfolio, right? Sometimes it's good to just sell a bit of your stock, take maybe $1,000 or $2,000 cash. That way, okay, you now have a little bit of capital on the side. You're not as leveraged, and it might be 1%, it might be 2%, it might be 5. And that way you have a bit of cash. You're not as exposed, but you're still invested. That's always a prudent thing to do. Many people don't understand, but you can hedge by taking a short position, but you can also just hedge by taking some risk off the table. Most people don't get that. And, we are seeing elevated volatility in this market right here, especially below the negative gamma zone. So do expect wild swings to the upside and downside. And ultimately, because we're below the gamma flip and because we're in negative gamma, I do expect the 5,000 strike to be our target. We want to sell into weakness, buy into strength, but ultimately we want to see the target of 5,000 right here, which is the put support. Now, very, very critical. It does look like the put support is actually going to move up to this 5,100 strike. If that is the case, this will then be the next target. So at the moment, anywhere between 5,000 and 5,100 to the downside is what we're looking at right now, until we get over the negative gamma strike, and then we'll be looking at the 5,300 target. Other than that, the best thing I can tell you in times like these, when there is just elevated volatility in the market, sit through the volatility. Now let's talk about breadth. Now guys, we are starting to see some divergence here in some of the shorter term breadth metrics. Now we can see a couple of glaring things. Number one, energy seems to be the strongest sector, both on the 50-day and the 200-day moving average. And we could actually see in the S&P 400, stocks above their 50-day, 57%, and where the 50-day average is rising, 65%. So these are still fairly healthy metrics. Below 50, that's when we can start to worry. Above the 200 200 moving day average, still very healthy across all of the sectors, bar utilities, real estate right here, and staples. So more like these defensive sectors. But other than that, on the 200 moving day average, everything is looking really healthy. Things do get a bit dicey here in small caps and then just in other sectors as a whole. So yeah, there's a bit of hiccups in the moving averages. Short-term averages are under pressure, but there's very strong momentum here in energy, and that just goes to show the inflation narrative happening right now. Looking at the risk on risk off ratio, so we can see that we've been in this risk on environment quite a while. It's definitely been risk on, and that isn't something that is changing just yet. However, we are starting to see that we have plateaued here, and not something we've seen since, mid to late 2023. Now, this level right here is an absolute key level. If we do get below here, this line, then we definitely are looking at getting more defensive, getting more risk off. But if we are above this line and we get to key levels in the S&P 500, this trend line right here, then we will just look to buy dips in the S&P 500. Now, looking at the yield spread between corporate bonds and treasury bonds, and we're still at very tight yields, which means credit risk is very low. If this was to tick up, then we could get worried, but we're just not seeing that massive uptick here in credit spreads that you would normally want to see in a quote unquote crisis. So this just goes to show that the fundamental picture is still sound and that there isn't much to worry about. And until this actually ticks up in a meaningful way, any pullbacks we do get in the market, we really just want to buy the dips because credit risk is still pretty low. Now, looking at the yield curve, the curve is still inverted. As you can see right here, it's a very deep inversion and has been inverted for quite some time. Many people see this as a recession indicator. I don't personally like to look at it, probably because in 1995, 1969, there was actually curve inversions and uninversions at these points, followed by no recession. So it's not actually a perfect indicator of a recession. You've been lied to, by the way, guys. Go look it up, go Google it. All those years, the curve did invert, no recession. What this is telling us though, is that Fed policy is too tight. That's exactly what this is telling us, and the Fed needs to go ahead and cut to normalize the curve. Are they going to do that? Well, things are on ice at the moment, but according to Joe Biden, there will be rate cuts this year. So hopefully we do get to see this curve normalize by the shorter end coming down. Otherwise, it looks like the longer end is going to have to move up in a very meaningful way to get this yield curve back to normal. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment. Cheers.